Okay, Chapter 13 on current liabilities. This chapter is sort of a hodgepodge of different topics, but they're virtually all related to current liabilities. So let's go ahead and get started. So first we have to go through some definitions and other things. First, a current liability is one which will be satisfied through the use of current assets or through the creation of another current liability. Now, 99% of the time, if you simply say a current liability is one which will be due within 1 year or one operating cycle, whichever is longer, that's going to work out fine. But there are going to be some exceptions. Now, if you think about it, how might you satisfy a liability other than through the use of current assets? Virtually all liabilities are satisfied through paying cash. You have a payable, you write a check. There will be some exceptions though. First, perhaps you might satisfy your liability through the use of non-current assets. Let's say you owe one of your suppliers $1,000,000 and you simply don't have the cash and you're not going to be able to get the cash, and you say to your supplier, look, I'll give you this parcel of land that I own. The land is a non-current asset, so if you're going to satisfy that liability, even if it's due next week, if you're going to satisfy it by giving up a non-current asset, then the liability is properly classified as non-current. Similarly, liabilities to be satisfied through the creation of non-current liabilities. A good example from your own life might be if you've got a 1-year adjustable rate mortgage. If you've got a 1-year adjustable rate mortgage, theoretically it's to be paid off within 1 year, which would mean it would be a current liability. If you show the ability and intent to refinance it with a long-term liability, then you can go ahead and classify it as non-current. Finally, liabilities to be satisfied through the issuance of equity. Again, you might have a large liability due next week. You simply don't have the cash, and so you might say to your creditor, I will give you X shares of my company's stock. Now, again, the vast majority of the time, if it's due and payable within 1 year or one operating cycle, it's going to be a current liability. These are some very limited exceptions. Everything else being equal, companies would much rather have a non-current liability than a current liability. Again, having a current liability tells readers that you have to pay cash within a very short time frame. So everything else being equal, companies would much rather classify things as non-current. This used to be really abused to a great extent, especially with that second exception with the non-current liabilities. It used to be that a company would have a major loan due within 6 months, and they'd say, no, we're going to refinance it, don't you worry, so let's go ahead and classify it as non-current. And then they wouldn't be able to refinance it, and everybody would be upset because it had been misclassified on the balance sheet. To sort of stop that problem from occurring, the FASB requires that in order to claim that a liability is going to be satisfied by refinancing with a non-current liability, you either have to have consummated the refinancing by the end of the fiscal year, or you need to have a written binding contract saying that you will be able to refinance it. Okay, again, this chapter has a hodgepodge of different things. One of the issues that they talk about is sales taxes. Sales taxes are an expense for the customer. The retailer simply acts as a paying agent, or as a conduit, as they say in governmental accounting. If you go to Dollar Tree and buy something for $1, you're going to have to pay $1.06, and Dollar Tree would record the following. They've taken $1.06 in cash, they've got $1 in sales revenue, and they have a 6-cent sales tax payable that needs to be remitted to the state government. Again, the sales tax is not an expense to the retailer, it's an expense to the customer. The retailer simply collects the money from you to forward to the state. Now, some firms include the sales tax in the sales revenue. So in this case, Dollar Tree, with $1.06 sales tax example, Dollar Tree would record sales revenue of $1.06. Then at the end of the accounting period, they would look at their total sales revenue and back out the portion that represents sales taxes. Given modern computers and modern accounting systems, you have to wonder, why would you do this? Nowadays, if you go to the store and they scan your product at the cash register, not only does that record the sales price and the sales tax separately, it also updates their inventory control system. It does. The strength and power of modern computer systems is such that there's really no reason to do this. But there is a financial reason. Imagine you sell things for a nickel. Now, sales tax is always rounded up. So if you sold one unit for a nickel for 5 cents, you'd take in 6 cents. 5 cents for the product plus plus a penny for the sales tax. if you sold 1,000,000 individual units, you'd collect 1,000,000 times 1 cent, or $10,000 in sales taxes to be remitted to the government. Now instead, assume you recorded each 6 cents, well, again that's a nickel for the sale and a penny for the sales tax, as sales revenue. At the end of the period, your sales revenue account would have a balance of $60,000, 1,000,000 units times 6 cents apiece. And you'd have to determine how much to take out and send to the government. Okay, let's do a little simple algebra. Let S equal sales revenue. So we'd have S, sales revenue, plus 6% of S equals 60,000. Factor out the S, so you have 1.06 times S equals 60,000. Divide through by 1.06, and so you'd say S, which equals sales, equals 60,000 divided by 1.06, or 56,603.77. So what you have is your sales is 56,603.77 plus 6% sales tax of 33.9623 for a total of $60,000. You send the government 3,396.23 instead of 10,000, and you keep the other 6,603.77 for yourself. So there's, again, sales taxes are always rounded up, so this will always be to the benefit of the retailer to do it in this fashion. Another topic which they put into this chapter is what's referred to as asset retirement obligations. Now actually asset retirement obligations tend to be long-term liabilities, but for whatever reason they put them in the current liability chapter. Sometimes we own assets which require some after-use costs. If you have a strip mine, the EPA or the State Department of Environmental Protection requires you to restore the land. You bring in some topsoil, plant some trees, and pretend it's all okay. If you've got a gas station, at the end of the gas station's useful life, you need to dig up the underground tanks and take away the contaminated soil. Across the river or across the street at 3 Mile Island. When 3 Mile Island shuts down whenever it shuts down, the power company can't simply close the door and walk away. They've got to, they're going to have eons of maintenance to try to take care of the plant after it's closed down. So how do you account for these future costs, these what are referred to as asset retirement obligations? Okay, so let's assume that on January 1st, 2001 we buy a coal mine for $1 million. At the end of its 10-year life, we will have to spend $200,000 on shutdown costs. This is a long-term liability, and long-term liabilities are recorded at their present value. Assuming a 10% discount rate, the present value would be $200,000 divided by 1.1 to the 10th power, or $77,108.66. So we're going to go ahead and add that $77,000 to the value of the asset and record it as a liability. So first we buy the mine for $1 million. Then we record the asset retirement obligation, adding $77,000 to the cost of the mine and putting this long-term liability on our balance sheet. Now again, the asset retirement obligation is a present value. Each year we're going to accrue interest on it. We use the effective interest method, so we're going to take that discount rate of 10% and multiply that by whatever the balance is in that asset retirement obligation liability. The first year, our asset retirement obligation was $77,108.66, I believe. So interest expense will be 10% of that, $7,710.87, and we add that to the asset retirement obligation. The next year, the asset retirement obligation will have grown due to that interest accrual to $84,819.53. So for year 2, we'll do the same thing. Interest expense will be 10% times the asset retirement obligation, or $8,481.95. By the end of the 10th year, interest has been accrued on and added to the asset retirement obligation to the extent that the balance should be $200,000, plus or minus a few pennies for a rounding error. We then pay off that asset retirement obligation liability by spending the money to do whatever it is that we have to do. So we spend the $200,000 on restoring the land or whatever it is, and that satisfies the asset retirement obligation. Now the total cost of the ARO was $200,000. That was recognized as an expense in 2 ways. First, we included $77,108.66 in the cost of the coal mine, which was depreciated over 10 years, or I guess, depleted since it's a natural resource. Second, we accrued over 10 years, we accrued $122,891.34 in interest expense, adding that to the ARO until it got up to $200,000. So between the two of those, over the course of 10 years, we expensed $200,000 um, as the cost of the post ownership expenses.